Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to a combined Charts of the Week and Market Minutes for May 2nd of 2022. Please see our disclaimer for important information. Well, we will certainly have some charts to take a look at. We're going to interweave that with some market commentary in light of the very weak and adverse market that we saw towards the end of last week. There's a lot of data that I know people are looking for, a lot of feedback, maybe some outlook, at least near term, and some things that are being done in portfolios in response to this. And we just suffice it to say we've been looking at portfolios really for about the last couple of weeks and kind of ascertaining, best routes to go given the expected environment. The environment's been fairly fluid, but there is certainly a lot to talk about. So I thought this week, in lieu of having the separate market minutes and charts of the week, that we both do them in one broadcast here. And so let's cover the charts again, not as many as we usually do, but high frequency data is something that is indicative of where the consumer psyche is right now, at least in terms of the components on this table that pertain to the consumer, namely hotel occupancy, open table. We see those declines on a weekly basis. The monthly declines are becoming a bit more pronounced as we see a little bit more impact from the shifts in consumption. And again, this comes on the backdrop of our GDP report and our consumption numbers, which are actually somewhat strong, but clearly they're being shifted in other directions, like more essential services, like people paying more for gasoline, say, for instance, and not spending as much going out to eat. So we can see that manifest in the data. However, TSA checkpoint data, very strong. I was in a couple of airports last week, and the flights were all full. Global commercial flights still about 20% below the inventory that was in the market in 2019. But again, the inventory that's in service now is quite full. We saw weekly changes that were positive there. Steel production positive on the month and the week. Rail car traffic down. Some of that has to do with consumer goods. We do see consumer discretionary being peeled back a little bit. Again, same dynamic there. People spending more for food and gasoline and not as much on consumption there. But weekly retail sales, we didn't have that data. Staffing, and we know the labor market remains exceptionally strong. Let's take a look at GDP, because this is kind of I'll call it the agent provocateur here, is you have contributions by sector. And we know it was down 1.4%. We know that number for the first quarter is going to be revised at least it's going to be revised 2 more times before it's deemed final. So the chess pieces could shift here in the next couple of revisions, but you see, in the blue line trending from essentially 2020 in the fourth quarter, which is a period where we had a significant bounce back. You can see the proponents of and the detractors from GDP, and in the latest quarter, you clearly see net exports were really weak. A lot of that had to do with the fact that GDP was impacted by a surge of imports that had been delayed, at docks and things like that with the supply chain issues, slowing, and inventories. Inventories, you can see, were also weak, and a shrinking government spending at the end of what turned out to be a pretty massive, massive stimulus overall last year and really the last 2 years. So long and short of it, trade deficit led to about a 3.2% net drag on GDP. So you can see that net exports there being fairly weak. But on the plus side, we did have fairly strong business spending, the likes of which we hadn't seen for a couple of quarters. And we also saw consumer spending continue to be beneficial, but it was not enough to offset essentially the trade imbalances there. And here's trade. Speaking of which, you can see exports, imports, both of those were negative. Again, the imports had a lot to do with the kind of the easing and the clog of some of these shipping lanes. And so a lot of inventory that was pent up at docks and whatnot. So that had not been essentially counted as imports yet. So we got a lot of that stuff on the market at once. And so again, that's not the only reason why. But that's a big reason why. You can see that this number jockeys around quite a bit, and so imports have been a drag. Net imports, I should say, have been a drag for several quarters now. But we just didn't get the export volume that we were looking for, and some of that has to do with the fact that the dollar has appreciated quite a bit this year. Now here's a GDP slide that has a forecast on it. It just represents a second set of eyes. There are a lot of opinions on where GDP is going to go. You can see the negative number that we just posted, and it's likely to remain negative through the 2 revisions that are forthcoming. But in this case, it's expected to perk back up to around the 5% level for a couple of quarters and then ease down into roughly the 2.5 to 3% range. Again, a lot hinges, when you look out towards the end of 2023, a lot hinges on the ability for the economy to navigate the federal rate increases. We'll talk about that. But also, I'm not sure necessarily if I would buy into the notion that we're going to have a bounce back to 5% next year. We did have, as you just saw, a fairly weak trade number, which was a significant detractor from GDP last quarter. And I'm not sure that that necessarily reverses. Again, strong dollar is going to make exports fairly weak because our exports are more expensive to the rest of the world, which right now is in a slowing pattern, if you will. So again, but I think ultimately, this 2.5 to 3% is probably valid insofar as we can tell right now. And here we have a few data points from the Kansas City Fed. Again, all of the regions of the Federal Reserve post this kind of data. And this just happens to be really the breadbasket and kind of the central part of the U.S. But I think it's very emblematic of what's going on nationwide. We see manufacturing index slowing a little bit, activities just kind of coming in because we know that demand is ebbing a little bit, and we see new orders, clearly a front end indicator here that orders are slowing in the pace of higher inflation. And here we see in the upper left-hand corner prices paid. So we know there's a lot of input cost inflation. That's well understood. If you're a food manufacturer, then obviously you've got a lot of price increases that are tied back to Ukraine and other areas of the world. And obviously fertilizer is a big problem. Russia's a huge exporter of that. But you're also seeing the impact of Chinese lockdowns on availability of parts, components, and kind of articles of intermediate production that eventually go into original equipment. All of those things have gone up, but on the bottom left, you can see where prices received is going up as well. So this is indicative of the fact that there is pricing power to recover cost input inflation, which ultimately is being passed on to you and I. So while we're seeing it eventually in the consumer baskets, producers are seeing it, but they're passing it along. And so, we haven't really seen, at least in terms of profitability, at least in the first quarter numbers, where companies are kind of taking it in the short, so to speak, quite yet. But that may change. On the right-hand side, a quick look in on the Evercore ISI trucking survey. 100, a higher number represents a stronger environment, and we see that number, rolling over a little bit. It's stronger in terms of pricing power. So this has kind of a double entendre here. So, as prices recovered and demand recovered in trucking and the health of the trucking industry improved, there was clearly some choke points. We do see some relief now, but that just means that the things are kind of rolling over. And I say, roughly normalizing. So that's actually a good takeaway here, that from trucking, prices are not as significant as they were a headwind for producers. But again, that's just one element of the whole distribution chain here. Here's a look at the Fed balance sheet. Much has been made over the fact that I think we're still in kind of a very easy credit environment. You can see the Fed balance sheet, after the global financial crisis, all the way through really COVID. We saw a little bump there right at the end of 2019, and then obviously the impact of the coronavirus and the ensuing stimulus that we saw, monetary stimulus in the form of quantitative easing, has really inflated the Fed's balance sheet. Now you do see $8.93 trillion, and we do see it leveling off, and it's just beginning to roll over now. So we are just literally on the precipice of this quantitative tightening, which will ultimately tell us if we're going to have a hard landing or not. Here we have from the Bureau of Labor Statistics an employment cost index. We did see a very high print in the ECI. In fact, it's really as high as we've seen it since in almost decades. It's very unusual to see employment costs jump this far this soon, but clearly something that's got the market a little bit jittery. Here's personal savings as a percent of disposable personal income. Now, we've been talking about consumers, households having a really healthy balance sheet, and that's still very much the case. With all the stimulus payments, households were saving more of what they got from the government, except in the lower income cohorts where they were spending almost all of it. But you do see now that we're kind of meandering back to our longer term trend line in terms of our personal savings rate, which frankly at 6.2% is, in the whole glass half full argument, that's actually an argument that's somewhat positive. We still have 6.2% savings. Now that could change obviously with input costs and gasoline, food costing more. But right now we're kind of settled right on that longer term trend line. Now we've got a lot of charts on the market, and you can see these titles here. The long and short of it is that we're in a correction phase, and that means a 20% retracement from the peak, which we saw at the end of last year. And so even though we've had a lot of gyration lately, in fact, we entered correction territory for the second time this year. In fact, we entered correction territory technically within 22 days of exiting the prior correction. So a lot more volatility these days, and you can see that evidence in just about every part of the market here. You've got discretionary, you've got communications, and you've got the Russell 1000, 2000. These charts kind of look very similar, and the timing of the peaks were all roughly the same. Here we have the Nasdaq Composite, and so again, very symptomatic of what we saw in the last slide. Just isolate this one because the Nasdaq's a fairly important and visible indicator, whereas the ones before, Russell 1, Russell 2000, are not as well publicized. But in this case, we got a 23% retracement from our peak, so in technical correction at that point. Here's a chart on inflation. So, the big question right now is, are we at peak inflation? Is inflation going to roll over? And I think there's a general consensus, and I spent a lot of time last week with other practitioners and some really smart industry analysts that study, and frankly, economists and quantitative strategists, and talking to them at length about thoughts on this. And so obviously, from Barclays here, they show us that base effects do matter. So when we, anniversary ultra high inflation, naturally, you need, super high inflation to kind of keep those rates of change going. And so when you have super high inflation like we did last year, kind of accelerated inflation, you would typically assume that inflation is going to slow its rate of gain just because of base effects, that it's hard to, basically double on top of a doubling, if you will. And so that's partially reflected here, in addition to the fact that maybe some of the issues tied to food and energy prices might begin to ease at some point. Now, we're getting some evidence of rig count increases on the energy side as high prices are finally inspiring, domestic oil producers to kind of get off the sidelines. Natural gas, you're seeing some, moves on the part of the administration to let more federal lands drilling that had been mothballed. You see more pipeline activity. Now, this doesn't change prices overnight. In fact, it's going to take quite a while, but the presumption here is that it will ultimately lead to a decrease. Obviously, in food issues, who knows how long the Ukrainian situation is going to go. Good news is it appears that Ukraine got most of its grain crop out of Ukraine before the war started. But in any case, there's a lot of things that go into inflation, obviously. And here's just one forecast that suggests that it will remain high as we go through the end of 23, but it will likely come down. And I think that's a fair argument. But again, that's not to say that inflation won't be high, because I think it will. Certainly higher than we've seen it. It just won't be the levels that we're looking at right now. Here's something else that I thought was interesting. Now, we talked about inflation remaining high. Well, really two things that will contribute to that. On the housing side, we've got rents, and then we also have wages, both of which are fairly sticky. And now we see more people coming off the sidelines. So the prime age participation rate, prime age being 25 to 54, are now coming off the sidelines, and they're getting back into the market after the pandemic. And so that number continues to climb. So, we talked about this great resignation with all of these quit rates. We see people getting back into the market. And so supply of labor is actually positive. If we add more supply of labor, then that ostensibly should help to mute some of the wage price inflation. Now, we do know that there's still 1.7 jobs available for every unemployed person. A lot of that has to do with the kind of the lower skilled service sector. But again, if you have more people getting into the workforce, you have a greater supply of labor, and that's probably a good thing. And we talk about the market a little bit, and we've got a lot of things to talk about. But clearly we've got equity flows, fund flows. A lot of people are getting out of the market right now, and so we've seen a lot of liquidation. In fact, on this chart that goes back to 2007, it's been fairly rare to see the dramatic drop that we have had here lately. And as we talk about portfolio moves a little bit, we've got durable versus discretionary demand within the S&P 500. So, where items where you have more discretionary demand, obviously, things that you don't have to buy, but you want to buy, those have taken it on the chin a little bit in favor of the areas that people have to buy. These are durable demands. These are like toilet paper. This is essentially like food and things that we require in our daily lives. And you can see that those two areas have clearly diverged in terms of market performance. Well, so I want to get into a little bit of the market. So, a lot of people have questions. The S&P was down 3.3% last week, and it's down 13.3% year to date, which is the worst start since 1939. Meanwhile, the Dow Jones fell about 2.5%, and it's down about 9.2% year to date. Obviously, the S&P has a lot of high-flying technology stocks. It's become a little bit more of a tech index. And we've seen a lot of those high flyers, and I call those long duration companies, really kind of take it in the chin a little bit. But Yeah, ironically, we've got about 70% of the S&P 500 companies that have reported their first quarter results through Thursday. First quarter earnings up by more than 10%. Good. 75% of companies have beaten expectations. Also good. But meanwhile, the S&P is down about 6% since earnings season really kicked off a couple weeks ago. So volatility is pretty high, closed at 33, which is well above the 200-day moving average of 21 and a half. And just looking through Sandy's commentary this week, we've had 25 4-month periods since 1992 when the S&P 500 dropped 10% or more. The index, by and large, has gained about 2.5% or 3% during the 6 months after those drops. And so, we've had, large drops at various points in time, like those that can remember in 1998 when we had the Russian debt default. We had a 14% drop then, and we rallied almost 30% over the next 6 months. And then we had the European debt crisis, the U.S. debt ceiling shutdowns back in the early part of the 2010-2011 timeframe. We had double-digit declines followed by large gains. Again, so there is the possibility of having a lot of volatility, but volatility offset that comes in the form of strong gains after large drops. But April by and large was a pretty bad month. There's no way of getting around that. The Dow Jones was down about 5%, S&P was down 8.8, Nasdaq was down 13.3, and those were the biggest monthly declines since March of 2020 for both the Dow and the S&P, and we haven't seen a drop like that in the Nasdaq since the global financial crisis, and it was the worst April performance that we saw in the S&P since 1970, and like I said, this is the second time the market has corrected this year. We're down 10.8% from the March 29th close, around 46.30. And then, so basically we fell back into correction literally 22 days, trading days after leaving the previous one, which is the kind of the fastest reentry, according to Sandy, since November 2008. Again, global financial crisis. So, we've got the worst inflation in 40 years. We've got the Fed expected to start aggressive tightening. Obviously you have some mixed results from tech stocks, although by and large, the entire market has delivered fairly strong earnings. We've got lockdowns in China. It seems like the rest of the world is moving into this endemic phase. Meanwhile, China's kind of still stuck. And we know that the International Monetary Fund, the World Economic Forum, the World Bank, have all reduced their forecasts, and particularly for China, moving it down. I see a lot of numbers like heading down to like 4.5% range, and China wants to maintain 5.5%, and historically has maintained a much higher level than that. So that's kind of the fuel behind this anxiety right now. On the 10-year, on interest rates, 10-year Treasury ended the week at about just under 2.9. So it was basically, I'd call it unchanged for the week, but up about half a percentage point for the month. So, and that's obviously going to re-rate risky assets like equities when you have a move like that. A 2-year Treasury ended the week at just under 2.7. So it was down slightly for the week, but it's up 41 basis points or 0.4% for the month. And over the last 9 months, according to Market Watch, the 2-year yield has climbed 2.5 percentage points, the largest 9-month gain that we've seen since 1994. So, again, real rates are very important. So, this whole notion of the Fed, trying to find an equilibrium point and all of the expectations for interest rate increases that are on the table. Folks are expecting, short-term rates at 2.5%. Well, right now they're basically at 0.25%. So we're expecting to get some fairly large rate increases at the next couple of Fed meetings. But the deal is here, so if inflation's going to be, call it 3.5%, but short-term rates are still only going to be 2.5%. Well, you still have a negative real yield in that environment, even though real yields have been increasing, but they've been negative. And so, you really need a positive real rate to create an incentive to save and provide the disincentive to want to borrow. And so you still have a somewhat, easy credit type environment that is actually favorable to risky assets in that environment. Other big deal is the dollar. The dollar's up 7.1% this year, and obviously a stronger dollar makes our exports more expensive and less desirable. It does make imports more desirable and cheaper, but it does hurt emerging markets. And so that's one thing that we're doing in portfolios is really kind of de-emphasizing that for the time being. I think a change in the dollar is going to take a while to manifest. But we've also seen, weakening in the yen, quite a bit. Japanese yen down 12% since early March. The Chinese yuan has dropped about 4% against the dollar in just the last couple of weeks. Euros down about 8% since July. And so when you talk about the Fed wanting to unload a lot of assets off its balance sheet, obviously you have to sell it to somebody. And the idea was that you're going to sell it to, nations like Japan and whatnot. But if you're selling treasuries to a company or a country that has a currency that's eroding against your own currency, then the cost of hedging could be problematic and might be a disincentive to want to be the acquirer of those assets. So in any case, so that might make it a little bit difficult for the Fed to unload. So a couple other things. So we talked about GDP a lot. A couple of the internals, we talked about the surge in imports. That's out there. So final sales to consumers. So I guess, if you want to like the pros and cons. So the positive outlook is consumer spending was up 2.7%, which is the highest in 3 quarters. Business investment was up 7.3%, the biggest increase in over a year. And so that you have a relatively hot domestic economy that is working okay. Now, on the flip side, you've got obviously the economy shrank in the first quarter, and real wages are dropping, and consumers, we saw them spend down savings, so the savings rate's not nearly as high, although consumer spending is up 2.7%. So, there are puts and takes in this GDP report. I want to make sure that people don't get too wrapped up in the headline number, because that inventory change was a really big deal, actually. So let's see. In housing, this is going to be something that we're going to need to watch, which I think it's actually quite the conundrum, because the Fed, the housing makes up 40% of the consumer price index, which we know is going up. So cost inflation on home prices is a problem. Affordability is going down. And because of that, and real wages being kind of stuck because of inflation, you got pending home sales in March were down 1.2% over the month. Mortgage applications to purchase a home are down 17% year over year, and refinancings are down 71%. So, housing also makes up a fifth of GDP. So it makes up a large component of the inflation basket as well as the economy. So, pick your poison, right? If you're going to attack, and plus most people own their homes, and then have significant stock holding. So in other words, the average household has much more of their net worth tied up in their home than they do in the stock market. So, the wealth effect is important here. So if you start attacking inflation, raising rates to kill inflation, obviously you're going to impact the housing market in a lot of different ways, right? If you're going to raise rates, it's going to make affordability problematic, which is going to decrease the wealth, and you could have some accelerants that could cause kind of undue harm on the consumer in that case. So not sure if I explained that completely how I wanted to, but just the key takeaway there is that it's housing is, a considerable part of the inflation basket, but it's also a considerable part of the economy as well. So, if you're talking about wanting to manage to kind of a soft landing, you got to watch what you ask for, because in this case, particularly with housing, there's clearly second order impacts that need to be managed through. I guess that would probably be a better way to say. But in all, the big news last week was the GDP number. We've talked through that quite a bit. Interest rates are still kind of reflecting at the longer end of the curve, kind of reflecting this uncertainty of where we're going to go. And that hasn't changed for a while. So we're seeing some flattening in the curve. We're seeing a lot of anxiety in the pipeline, and I think that's reflected in the market. Consumers still strong, households still strong. Housing, we just talked about, a little bit in flux. Fed funds futures market is pricing in, as I said, a rate of about anywhere between 2.5% to 3% by the end of the year. And so, engineering a soft landing is hard, but in some respects, the soft landing is actually being engineered as we speak, and policy is not having to do as much of the work, because short-term rates, as we just noted, have gone up considerably, 250 basis points or 2.5 percentage points on the 2-year Treasury. So, and the market could actually, slow ahead of, the Fed really getting involved. And when you change interest rates, the transmission into the economy takes some time. And so, I think, we'll get half a percentage point of rate increase at the meeting coming up here literally this next week, and then we'll probably get another 50 in the next meeting later in June, which will kind of put us well above, well on our way to at least 1.5%. Now, that's not enough, in my opinion, but at the same time, you could have an easing in economic conditions because the economy will anticipate this. And I think, that could be something that does actually help our equity markets. But in the meantime, we're really taking out remaining duration. We're adding commodity exposure. That's a part of the market that's doing exceptionally well right now. We're powering down the international markets. We're taking all the remaining money right now out of emerging markets until we get a sense of better conditions there. Certainly, it's going to require a bit of a weakening in the dollar. But really focusing on quality, knowing that the long duration assets, and certainly stocks that are not profitable, that don't pay dividends, those have, in this environment typically have worse prospects. And then also the cyclical trade that we enjoyed last year is really kind of unwound in the wake of the current conditions. So for the time being, we're kind of putting value back up on the shelf and just looking for quality with cash flow. So that's really where we are right now. Well, that's all we've got. I hope that this is helpful to combine these two broadcasts and just kind of give you a kind of a straightforward sense of what's on my mind these days. And in behalf of the entire team at BKA, I hope you have a wonderful week, and we'll talk to you again soon.